All right, everybody. I see that this says someone started recording, so let's get this going. We all know Andrew. Andrew is like this startup king, VC guru, but I have a quick bio on Andrew, not that any of us need to know anything more, but Andrew is the executive director and general partner of Golden Section Ventures, an early stage enterprise software investment fund. His background is in running financial organizations within hyper-growth companies that belong, helping them to build out the structure for rapid scaling. With GSV, his main focus is raising capital, managing fund operations, and working with portfolio companies. Most importantly, he is, of course, a member of our Leadership Houston Class 40, the best class ever. So that's on Andrew, but I know, Sergio, you guys may have some quick announcements we want to make before Andrew goes into a little bit of his presentation. Gonna do this. Alrighty. First is Class 42 applications close very soon, in about a couple of months. So if you have any folks, please send them in. Next slide. Alrighty, we are doing our Inspire Lunch. I know a lot of folks that are on this call. I know Rima and Ramit and others are part of, and I'm probably missing a lot of others that are helping to put together this Inspire Luncheon. It'll feature Mayor Turner and also Sanjay, who is the current board chair for Metro. They're being honored as Leadership Houston as a big first annual luncheon. It's also a big fundraiser for Leadership Houston as well. So I encourage everyone to go. It's this upcoming, not this Thursday, but the following Thursday at the Junior League. You can still buy your tickets. I believe it's $100 per ticket. So go ahead and buy it today. Alrighty, and then a few shout outs for our awesome folks here. This is Shannon sharing an Emerge Luncheon last month, or this month. Landy being featured by the GHP. International Women's Day, you'll see a few of our classmates there in the center photo and on the sides. This is David, our our amazing person who's helping us read to the Final Four, and of course Dorita, who is on the huge part of the PR aspect of the Final Four that I believe begins very soon. I don't know sports, y'all. Southwest Management District did a great event with Reese, who is, of course, the commander in that area of Southwest Houston. Kareem presenting a case study to HCC students here in conjunction with Rima. And then, of course, we're having a Final Four miler running event coming up. So sign up today. Sergio is the chair of Family Houston's board, so join him for his luncheon. The Crawfish Festival from the Buffalo Soldiers Museum, so Desmond's involved with this, so help him out. And in our next happy hour that I think David and the social committee are putting together. All right, and take it away, Andrew.
Thanks so much, Ben. I'm going to share my screen real quick. And it wants me to update my. It's really helpful.
Kimberly, we're just working on the presentation, putting it up, and Andrew will get started. Oh, there it is. I see it, Andrew.
All right, we are good to go. Can everybody see the screen? What is venture capital?
Yes.
Cool. So today we're going to talk about venture capital. been in the news a little bit with the Silicon Valley Bank thing, and yeah, a lot going on. Kind of an interesting time for venture capital. So hopefully we can have a good conversation. But I wanted to start with just kind of a broad overview. And I will say, if you want to jump in with questions, feel free to just do the hand raising thing or just jump in kind of as we go. Try to make sure I'm not using too much jargon or weird acronyms or things that people wouldn't know. So if there's a question, don't hesitate to just kind of jump in. So what is venture capital? Typically what that means is a fund, and a fund is a legal structure that investors pool in cash, and the GPs or the managers of that fund then go and invest that capital on their behalf. Typically, a fund has a strategy, whether that be, early stage software, hardware, space. Really, your strategy can be anything, but typically funds have kind of a focused strategy on companies they want to invest in. Not all hardware, software. Some, CPG brands, which would be consumer packaged goods, like things you would see in the grocery store, stuff like that. So there's typically a strategy associated, and the managers usually have a background in that sort of vertical, and so they should be, well suited to make investments in that space. The goal is to make investments in companies, have those companies grow, and then ultimately exit those businesses or sell them. A lot of different ways to do that. Typically, you can merge with other companies, get acquired by larger companies. IPO is one that people talk about a lot as basically going and selling shares on the public market. And there's lots of other ways where people can get acqui-hired, where their company essentially gets bought, but really just to work for a different company. But in short, the exit event is what people are getting in this for, because that's where everybody gets paid if it's done right. Structure. So I talked a little bit about this. Typically in a venture fund or private equity fund, there are kind of three different pieces of that. One is the general partner. That's the managers of the fund are effectively saying, this is an entity that will go and we will manage the funds on behalf of the limited partners. And I'll talk about how money gets made in a second. The limited partners are investors into the fund. So that can be, family offices, high net worth accredited individuals, or institutions like pension funds or foundations, things like that, university endowments. You may not know that a lot of times those entities are investing in venture capital. So as a part of their portfolio mix, I think Yale typically is famous for their allocation to venture being something like 22% of their fund, and they're one of the best performing endowments of all time. And then the third piece, so you've got the general partner, limited partner, and then the third piece is the management company. This is typically the operating entity. So this is, if someone says the firm, they're talking about the management company. Typically, the management company gets paid by the fund, and essentially the dollars there are what keeps the lights on. So that pays salaries and any other sort of expenses in running the fund. The management company is paid by the limited partnership through a management fee. Typically 2%, can be as high as 3%, but that is an annual fee paid to the management company to operate the business. This can be, sourcing deals, helping manage the diligence process. Really, all of that stuff gets encapsulated in the management company. And then that fee that has been paid out over time gets paid back to the limited partners when they start making distributions. So if you're a limited partner and you put $1 million in, and we take a 2% fee of that every year to pay our organizational costs, before the managers get into their income, which is the carried interest, we have to pay back all of those management fees and make all the LPs whole before we can see any of the carry. And the carry is where is what VCs get into the game for, which is a 20% interest in the profits. So say we have a $50 million fund, and we make investments and sell everything in that fund, and total proceeds back is $200 million. Well, we as the GPs we don't make any money until we return all the capital of the 50 million back. And then we split the extra 150, 80% to the limited partners, 20% to the general partners. And so that's how general partners make their money. And so ideally, you're sort of aligned on generating as much upside as possible so that you can create a bunch of cash for the general partner, but the LPs, they win the biggest. This is a little chart that I borrowed from someone because I think they do a better job of just kind of laying it out. But this might help understand kind of the relationship. So here at the top left, you've got the fund managers. These are the individuals, and they're investing into the GP in the blue circle or blue oval there. The GP is the general partner entity that owns, you can see the arrow going back, 20% of the fund's profits. And then below, those same individuals own the management company that I talked about earlier. And then you see from the fund, 2% of the management fee going in every single year to operate. And then of the fund, if you look at the top right, this is the fund's investors that are investing capital into the fund. And you can see foundations, individuals, other corporations, fund of funds, family offices, all that. And then at the bottom, you have the assets within the fund, which are individual portfolio companies. So more about limited partners. So you think, who are these like crazy bigwigs that are making investments into venture capital? And in some cases, that is the case, right? Huge pension funds, for entire governments are invested into venture capital funds or private equity funds. Family offices, which typically, if you're not familiar, are offices where there's been a big wealth event in the family, and they stand up a family office to make investments, a lot of times with the goal of preserving capital, so that it's basically can be there for generations. University endowments are big ones, but really there's individual investors that can invest in venture capital funds. And there's a requirement there from the government that individual investors need to have 200K of income in the previous 2 years or a net worth of $1 million, excluding your primary home. And there's been some interesting developments. A lot of people are talking to the government about, going to Congress and saying, hey, why is this the case? I feel like we're excluding an entire asset class from the normal person. And so there's been some interesting potential developments there where to democratize access into venture capital funds, which would be pretty interesting. So there's some interesting stuff happening there on Capitol Hill. Here's some kind of terms of the fund, and I'm happy to dive into any of this stuff if anybody has a question. But so in a fund, typically it's an 8 to 10 year fund life, where that means it's a closed-end fund that you make investments typically for the first 3 to 4 years, and then the remainder of that time is called the harvest period. So you say, okay, we're going to make investments for 3 years, and then the next 5 years we're going to be just harvesting returns on those investments. So in that period, you're trying to grow the companies and find buyers of the companies to exit, and ultimately all of the proceeds from those sales you distribute back to the LPs. And then there's also a fund type called the evergreen fund. So in an evergreen fund, you're kind of always making investments. There's no closed end life of the fund. So as an investor, you need to have some liquidity windows where you can either pull your capital out or put more capital in. It's a bit of a different structure, but a lot of funds like it because it's a little bit more of a long-term focus where, maybe your goal is to get into companies and, partner with them for 12 to 15 years. And if you're an investor that doesn't mind waiting that period, then it can be a really cool structure. Management fees, talked about that before. Most typical 2%, really to operate everything. And then the carried interest or the carry is 20% typical, and you'll hear that as 2 and 20, as 2% and 20%. Some funds go as high as 3% management fees. A lot of the bigger funds that have been around doing this for a long time, they'll charge much higher carried interests because they've got a ridiculous track record, and so they can effectively they can get that. So they'll charge 30-35% carried interest on the upside. Sometimes you'll have a preferred return. That's more private equity where, if an investor invests capital, there's a interest clock that's running so you've got to cover, 8% basically back to them. That's kind of guaranteed to them before you can get into the carry. And then there's just waterfall structures where kind of how you get paid, but essentially European waterfall is, the managers get nothing until all capital is returned to the LP, and then you split the profits. And then an American waterfall is done on a deal by deal basis. So you allocate whatever amount of fees and other costs to each deal, and the managers can get into the carried interest on a deal by deal basis. Let's talk about the status quo. So right now, and right at this very moment, it's tempered a little bit, but there's been this focus, and I think once the term unicorn got coined, everybody decided to start using it. But that's basically saying, creating a business with $1 billion valuation. And that's kind of the goal for a lot of venture capital firms, is to say, we're gonna invest in 40 companies. We just need one of them to be a breakout to return the entire fund, and the rest of them can be sort of middling, or they can go to zero, and that's okay. So if you have the one sort of unicorn in your portfolio, then that can cover up a lot of the losses on other deals and still provide returns to investors. And that's how most funds are structured, to where they have 1 to 2 that really drive most of the returns, and the rest are just sort of middling, or total losses. Typical ventures, they're looking at about a 40% total loss ratio in their portfolio. So if they invest in 10 companies, 4 of them are going to just absolutely lose everything. So it's not a great structure in my mind. We do things a little bit differently. And so I'll go into a little bit of that more. But if you look at maybe your LinkedIn or any sort of, Crunchbase or TechCrunch, kind of these folks that are talking about venture capital and investing, you'll see a lot of stories about how much a company has raised, which is the sort of signal of success at the moment. But what we think is interesting is nobody's talking about how much revenues companies are doing, right? Business fundamentals have kind of gone out the window in favor of companies that can raise a lot of money. And so there's this signal that you're successful if you can raise money. But we've seen time and again where companies go raise, multiple millions of dollars and still can't start generating revenue. So we look to create value rather than just chase valuations, right? So most other VCs would come in kind of at the stage we're at and make an investment, and they're going to rely on what's called a third-party mark. That's basically saying, okay, we invested in a company, their valuation was $10 million. What we want them to do is spend all of our money so that they've got to go raise another round of capital, hopefully with the right growth signals, and they can raise that capital at a $20 million valuation. So now me as VC investor number one, on paper, my asset is marked up 100%. So I can go back to my investors and say, look how great we're doing. Look at these valuations. But in all reality, there's nothing really there. It's all just a signal of valuation, because these companies are worth nothing until they actually exit. And so there's this weird sort of game that's played where it's really just encouraging founders to be not reckless with capital, but not as efficient as they could be. And so they're just burning cash much faster than they otherwise probably should, in the name of being able to go and get another investment from another fund. What happens there too often is that founders get diluted, meaning their equity becomes smaller and smaller in their own company, to where there's really a misalignment with them and their investors, because they're saying, okay, we're just going to go and raise capital because that's what you do. And so we need to do that and just get huge and try to go really fast. And what happens is, in like 65% of the cases, founders that got VC investment, when they sell their business, they walk away with nothing. And that's because these firms have stacked these like preferences on top of each other, to where the founder, even if they may have 10% of their business left, but they've got to return all this preferred equity to their investors, and they can walk away with nothing, which is, I mean, it's unacceptable, and it's become the norm where founders forget about what they're building and can really miss out on what should have otherwise been a massive wealth creation event. And so, yeah, so noted here, nobody cares about business fundamentals. We focus on revenue and growth and how to make companies, better and sustainable for the long term. We think in doing that, there's going to naturally be a buyer for any company. If you can build a business that generates revenue and ultimately could generate profit, there's going to be another business that's willing to acquire it. And then in the whole scheme of things, like, people see venture capital as this super risky asset class that, what if it goes to zero, that kind of thing. And that's because of a lot of this value destruction that's been done in the industry where, companies are being invested in, but being pushed to spend money irresponsibly, that then can be to the detriment of what otherwise would be a strong business. And so it sort of creates this risk that shouldn't otherwise be there. I mean, software companies, especially, this isn't a new industry, right? It's not like we're investing in the first software company. Software as a service has been around for 18 years. And so this asset class is pretty sticky, especially in the B2B software world, where the revenues and the contracts these companies are getting are incredibly strong. You should be able to build a sustainable business that way, but being forced into an inefficient sort of capital stack and uses of funds just forces these companies into insolvency a lot of times. So I'll pause there. So that's kind of venture capital in general. Would love to see if there's any questions on that, and then I can dive into more specifically on software itself. Fantastic. Thanks for the coffee break. So software as a investment opportunity. In software, there can be a lot of different kind of consumers, or customers, one of which is consumer software, right? So the things you may use, productivity tools, Gmail, right? Social media, all of these are sort of consumer software applications. We don't play in that pool just because we're more well-versed in business-to-business software, selling workflow solutions, things that you guys probably use half a dozen of on a daily basis just to do your job. That's the kind of software we want to make investments in. So you have some consumer software, you've got small, medium-sized business software, think, QuickBooks, things like that. And then enterprise, which are, the larger SAPs, or, where you're selling into large organizations where the sales cycle can be really complex and long. That's kind of where we really want to play, is the software you're basically going to be selling long-term contracts to large businesses. And when a buyer comes along, that's a really interesting customer set because that revenue is incredibly sticky. Then there's the good thing about software and why it's eating the world and gets so much venture funding and funding in general is scalability. So what we always say is, if you're a real estate developer or you're an investor and you buy a building, that building is maxed out by its footprint and whatever the size is. So, you've only got a limited capacity for tenants, but in software, it's as if that building could grow continuously and take up as much space as it wanted to and never have a max capacity of tenants. That's the beauty of software, is that it's infinitely scalable. The only thing limiting your scalability is your market size. So I talked a little bit about different types of products in software. You got social media, marketplaces, like there's B2B and B2C marketplaces. B2C would be like an Uber, right? So somewhere you're getting on to a piece of software and it's pairing you with someone else, and there's a transaction that takes place. And the B2B side, there's a lot of interesting ones. We've got a few in our portfolio. One of them is kind of similar to Uber, but it's with long haul truckers and matching them up with loads that they can then take. So it's sort of an Uber for that space, and that's specifically a business to business use case. So there's all kinds of stuff like that. Workflow applications, both for consumer and business, mostly in business, but basically, software that helps people do their jobs either better or more efficiently. Productivity tools that people use, games, and then kind of a lot in the news now is machine learning and artificial intelligence. These things are seeing application like in every corner of the world, whether it be chatbots or healthcare. I've seen lots of tools that are using machine learning to even in some cases diagnose patients based on analyzing imagery. So a lot of different applications in the AI space. There's also tools in security that maybe you don't interact with specifically, but that sit sort of behind the scenes and can help with information security. And then I wanted to lay a little bit about kind of what I think makes a good software company. And a lot of these are what makes a good company anyway, but the things we like to look at when we make an investment is the team, obviously, the people behind the company. Domain expertise is a big one for us. If you're going to go and sell into restaurants, we'd love to see that you've got experience in the restaurant industry, right? You know how to talk to those customers. You know what their needs are. Founders are going to know that better than we do because we can't be experts on every vertical. But if our founders can be, then we can rely on that. We put value in the fact that someone's founded a company before because they know the struggles and the effort it takes to get something off the ground and get it growing. And then beyond that, have they sold a company before? If the founder's got an exit under their belt, they've kind of gone, full cycle in the creation of a startup to where they've built it and sold it to someone. And so that's kind of a big skill set that not a lot of people have. So we think that's pretty important. And then on the founding team, especially in software, we encounter this thing that we call the unique genius problem, because most software companies, either if the founder themselves is not a technical founder, aka they don't write code and develop software, then they've likely hired or co-founded with a CTO who is, to that founder, a tech genius. And so what happens in software is that tech genius then has a black box of building software where the founder sees nothing but like it costs money and I don't know if it's good or not. They rely on their unique genius person to be the knower of that. And in a lot of cases, that person maybe knows how to write code, but isn't a gifted product person. So they don't understand how to like rein in what you're building and build for the right purpose and build with the business use cases in mind. So we look for that where there's maybe a unique genius. And then we look for strong business fundamentals, as I mentioned before. So things like revenue is important, growth rate, low churn, which in software and a lot of other contracts, churn is basically clients that stop using the product and cancel. And then capital efficiency. We want to see that companies understand how to grow a business in a sustainable way. They don't just get drunk on spending cash. And then product market fit, you've probably heard of, but we use what we call the man with a hammer problem. And the man with a hammer, everything looks like a nail, right? So you see a lot of companies that will have an idea for a product and think, oh, this is going to be great. We can sell it here. We can sell it to this company, this company. And what they find out is no one's willing to pay for it. It's a novel idea maybe, and it's a nice to have, but companies don't want to shell out cash. And so you've got yourself a problem where you've got a product with no one that will pay for it. And so that's where we try to avoid any kind of mismatches on product market fit. And then we look at the actual software itself, sort of just like if you're going to buy a house, you're going to get an inspection done. We look at the software to make sure that it's built in a way that's scalable and not going to inhibit its own growth, and avoid costly errors. Because when we make an investment, we don't want to see most of those dollars go back into fixing something on the product. So we look kind of at that piece as well, which may seem weird, but a lot of the funds I've talked to, they do a pretty cursory look at the actual software itself and are investing more on the founders. And so to us, it doesn't make sense to make an investment into a product that's not built well. And then I put a couple of suggested books here if you want to learn more. Venture Deals is a super easy read, and it'll give you a good idea of what venture capital term sheets and deals look like. And then the business of venture capital is very textbooky and kind of, this is how everything works. And so that's some, if you wanted to read a little bit extra outside of this, then I would recommend those two. And that's it. Would love to take some questions if you guys have any. And yeah, open to chat.
Thanks, Andrew. I had a question on my side just real quick. I mean, I have several questions, but just kind of
Wow, we had a lot
your
of people
background.
join in the last, while I was doing that.
Yeah, for sure. We get a lot of folks very interested in this space. What got you interested in this? Because I think we heard a little bit about your bio, but how'd you get your start into this world? Can you guys hear me?
I can hear you.
Okay, cool. Did you catch my question?
I did not, sorry.
Okay, no, okay, so cool. So I'm curious. I have lots of questions, but I'm curious to learn more about you on how you got your start in this space. We got a little bit about your bio. Can you give us some more flavor though on how you basically made your way to where you are today?
Yeah, so I was I got approached by another venture firm. They needed a CFO for one of their portfolio companies, and at that time, I told them, I appreciate it, thanks but no thanks. I'm trying to retire from accounting and finance and not lean into it harder. But what the deal we worked out was that it would be a short term, like, hey, come in for a couple of years, get this thing on the right path, and then let's figure out something else. And so that's what I did. I stepped in as the CFO, but really as the COO as well, and so built out a lot of procedures and tracking metrics, building out a sales team, building out really what is a sales organization, beyond just guys going around trying to slang contracts. We would go and actually build out, hey, here's the process for actually selling, and here's how we record and track leads and opportunities so that we can see that we're getting better. So did a lot of sales enablement and kind of organization there, and then all your traditional CFO and controller type work as well. But yeah, so did that for a few years, got the business in a good spot, to where break even profitability was like right on the horizon, doubled the revenue. And so I went to those guys and said, hey, let's, what's the next step? And they were invested in the Canon. I don't even remember that at the time, that the co-working space. And they were thinking about this venture studio opportunity. And I was like, well, yeah, I mean, that sounds perfect. I could help do that. I've worked with fast growing companies a lot. And so we started a venture studio within the Canon. We got it going. We got a couple companies in the portfolio, but ultimately they weren't super into the idea of funding it to the degree it needed. And so we did that for about 9 months, and then I decided to go and we did a different deal. And so I had met up with these guys, a couple of my partners before this, and so we were talking about kind of the lack of venture funding in the city of Houston, and it's grown immensely since 2018. But really, there was only a couple players in the city, and so one of my partners through his family office had done some software investing, and so we kind of put a track record together there, and really built out the thesis for our first fund, and went and started raising money in summer of 2019, and then closed that fund at the end of 2020. And so, yeah, we've got a real knack for picking the exact wrong time to be raising money, because we had our first close at the end of 2019, and we said, oh, this is going to be a piece of cake, no big deal. And then March of 2020 hit us in the face, and the public markets dropped like 30% in the course of a week. And so all of the potential investors were just like, we're going to pause for a minute. And so we kind of had a little bit of a lull period there, but then things picked back up in the summer, and ultimately we raised the first fund. And we've done a lot of investments out of that fund, 12 deals. We've actually sold one already, which is pretty early for a venture fund to be distributing cash back just outside of the 2-year anniversary of the close. Most of the time, you're talking about year 4 or 5 before you see any capital as an investor. And so now that kind of the successes there got us into raising our second fund, which we're doing now. But yeah, that was kind of it was a windy path into venture capital.
That's cool. And I guess I mean, I don't want to hog up all the questions. If other people have questions, please chime in. But raising funds, I know there's a lot of networking, but how do you go about that? I mean, I know there's regulations, I guess, as to who could be part of this investment class, and there's work to maybe open that up a little more to folks that don't have $200,000 a year or $1 million in assets. But how do y'all go about raising that capital?
Yeah, you nailed it with networking. It's most of our capital comes from family offices. Most of our capital comes from Houston, actually. We've got a little bit in San Antonio, small bit in Dallas, Detroit, oddly enough. But yeah, most of our capital is from the Houston area. So it's a matter of just asking people, right? So obviously you might know people who are in a family office or invest in things. But really it's about kind of talking to them, building relationships, and then they want to introduce you to such and such that they know that is looking for venture capital investments or that kind of stuff. So it really is, it's about building a network and just building relationships. And we try not to be transactional in our relationship building. So we want to be helpful and kind of have it be a two-way street with anybody in our network. So yeah, but it's just sort of classic relationship building.
Sounds like a lot of hard work there. I did have another question before I stop hogging the mic. I'm sorry. I'm just really interested in this space. When you look for, how do you find which companies to invest in? Like, how does that work? Do you go seek them out? Do they come to you? How does that work?
Yeah, I mean, most of that honestly this entire industry is built on networks. So, we have relationships with other venture funds. We have relationships with even service providers that serve, early stage companies, whether that be banks or lenders or accountants, that kind of thing, that just know companies that might be a fit for us. And so over time, over the last 4 years, we've been able to build out a pretty substantial network to where when people see stuff that fits kind of what we want to look at, they'll send it our way and make introductions. And then we do some outreach as well. I mean, we do email campaigns, digital advertising, just to kind of be top of mind and get in front of people so that, when companies are out looking for capital, if our story makes sense, then it could be a good fit.
I'll yield the floor to others. I still have more questions, but please, if others have, I'll give them 20 seconds before I keep chiming in. Maybe 20 seconds is too much time.
Yeah, fine. I'm happy to discuss how any of the, how the sausage is made, because I know it can be sort of this mysterious industry where it's like you hear about venture capital, but most people don't know anyone that does it. And so happy to open up the doors.
David, are you about to say something?
Question. Yeah. Hey, Andrew, it's David.
Hey, buddy.
Hey, so without going too much off on a tangent on the financial piece, I guess what I was sort of brewing in my head that I'd love to get some thoughts on is, so like you mentioned, you hear a lot about venture capital companies talking about, we raised this much money, but that's not really what the whole financial picture is about, right? It's not just how much money are you raising. What are maybe like 2 or 3 pointers that you would suggest looking at when you're just trying to look at a company and get a snapshot of, like, do these people have their financial situation together? Do they not, outside of how much money they're raising?
You're talking about like a potential portfolio company?
Yeah, like a potential company that you would acquire, a company that's backed, by VC money. Like, just trying to look at a snapshot of, like, okay, what's their financial health really look like?
Mm-hmm.
outside of how much money they're raising?
Yeah, I mean, for us, we look at top line revenue. There's a metric that a lot of folks use in this space because most, private equity or other sort of financial buyers, they're typically looking at companies that are profitable. And so they use a lot of, discounted cash flows or other techniques to kind of say, what is the valuation of this business today based on the future cash flows? But in a software company that's burning cash, AKA they're losing money every month, you need to have a different metric. And so people use something called Rule of 40, which looks at your profitability and adds profitability to your profitability percentage to your growth rate percentage. And so around 40 or better is good. So say you're growing at 50% a year and you're losing 10% a year. So that would be a rule of 40, right? And it would be 40. That's a good company because you can see, especially with software companies, the revenue is a number, and then you have the costs to deliver that revenue. And then, you subtract that out, that's your gross margin. Most companies, it varies, but in software companies, the gross margin is typically like 85, 90%, which means your cost to deliver your revenue is incredibly cheap. And so everything below that line, if you were to say, okay, if we trimmed out a ton of these costs, could this company be profitable? And typically with a software company, there's a lot of costs in the organization that don't specifically drive revenue, that if you trimmed those out, you're looking at maybe something that could be profitable to the tune of 60, 70% of all your revenue goes to the bottom line, AKA is cash flowing. So that's why software companies see these crazy multiples, is because their ability to, if you wanted to, they could be cash flowing overnight.
Gotcha. Okay. No, that's super helpful and definitely gives me a couple things to look up.
Yeah, we like to look at the growth rate's really important, and then your the actual customer contracts. So if you're just like, hey, we're growing really fast, but then you see that, over the course of a year, 30% of their customer base is canceling their service and not continuing. They're just able to sell more, right? So even if a company's growing really fast, but you see their churn numbers are super high, well, that could be a case of maybe a poor product market fit, or a case of maybe they're just bad at servicing their customers. But in some cases, over time, you're going to run out of customers. And if you've churned most of them, it limits your kind of upper level. And so churn is a big one, revenue is a big one, and growth rate are kind of the big financial pieces. And then, cash in the bank.
We have a question in the comments. Kimberly asks, where do you think the conversation on accredited investors will head? Lowered limits, and if so, expected timeline?
Yeah, so there's another conversation happening too with, I'll answer that, but then, so a fund like ours, there's a limit to how many investors can be in the fund before you have to, like, basically, it's not a huge hurdle, but if you have more than 99 investors in the fund, there's some additional, you have to report to the SEC and meet some different requirements, which is just, especially for investing in companies this small, is just a little bit extra. But what that does is it can limit the number of small investors, because if you have people that are accredited that maybe they only want to invest 50 grand or 100 grand, they can't do that, because a lot of funds will be like, well, if we're trying to raise $100 million and everybody's investing $100,000, we're going to be over our 99 threshold real fast. And so it limits the ability for people to get access. And there was a guy that was on Capitol Hill a few weeks ago. He was arguing to increase the number from 99, to be able to open that up and democratize access a little bit more, which I think is an excellent thing. And so that's one thing. And then I think there's been pushback on accredited investors, because the argument is, I mean, it's my money. I should be able to do whatever I want with it. Why would you limit the normal person from being able to invest into a different asset class, right? I mean, as a a non-accredited investor, really your only option is the stock market or maybe some real estate deals, things like that, that sure, you can diversify your own portfolio, but unless you're getting access to any and all asset classes, you're not really truly diversified, and you don't get the opportunity to have, you know, the access to some of these outsized returns that venture can bring. I think our first fund, we think it's probably worth 5 times what's been invested in it, based on kind of the revenue that we've generated in that portfolio. And there's not a lot of places to put your capital that you can look at a 5x return within a few years. So sure, sometimes in the public markets there are opportunities like that, but really venture can provide some outsized returns to investors, and a lot of people aren't able to access that because of the regulations. And timeline, I don't really know. Yeah, I think opening up, finding a way to help get people to maybe lower the accreditation, whether that be, here's a waiver form or something like that, where people can say, look, whatever, I'm not even technically accredited, but I understand the risk or whatever it is. I think that's fine. I think the government is worried about predatory, people out there just like, more recently, there's nothing, I guess inherently wrong with crypto, but more recently there's been a lot of scam artists, raising crypto funds and just duping people out of their money. And so I think the government thinks, well, this accreditation deal should help that. But just because people make more money doesn't necessarily make them a sophisticated investor, which that ruling is essentially implying that just because you have more money makes you a better investor, which is patently false.
Right. And I had another question. Just you said you just sold the company. Can you tell us a little more detail on what that company does, and maybe a little summary of maybe some of the other companies in your portfolio? I'm interested to learn about that.
Sure. Yeah. The one we sold is a company called HLA Data Systems. I'm not sure if it's public yet. I know the acquiring company is a publicly traded business. HLA Data Systems is a lab information management software specifically for transplant labs. And so for us, it was a fit because we like things that can be in a niche market, so maybe limited on the total addressable market, but that can own that niche. And so there's like 105 or something of these HLA labs in the US, which is pretty small. And so, but what they do is they built software specifically for that use case, and they're able to go sell it and talk to these hospital systems or health systems to sell that software. And because they speak the language, the CEO's a PhD, they can get into those customers and sell to them. But it's a very tight niche that they are able to exploit. Oh, and then let's see, other companies in the portfolio. I mentioned the Trusted Dispatch doing the kind of Uber for long haul trucking. We've got one called Care, which is interesting. It's a marketplace as well of labor staffing. They serve senior living communities and skilled nursing facilities, basically where these workers, they call them heroes on their software. You can keep your day job and basically you can go and get on the Care platform, pick up a shift at a different community, and go work there, right? So it's a way to make more money or find a new place to work, all kinds of good stuff. They've grown really well. And I think the first week or the first learning day we had with Leadership Houston was, and I'm blanking on the professor's name from Rice, but he talked about the fastest growing age cohort in the US today is 80 and up, meaning senior living is here to stay and going to be a growing target market for a long time. And so there's been tons of software that's popped up to serve senior living communities, senior care, all that kind of space, because we're getting older.
Yeah, definitely looks like a growing market. So we're running out of time, but I did want to just ask this final question. If people are interested
and learning more, maybe even investing, I mean, how can we go about that?
Yeah, you can just hit me up directly, Andrew@goldensection.com. Or a lot of you might have my phone number, or from the directory have my phone number. But I'll throw it in the can the chat be visible on YouTube? Because I'm gonna not put my phone number there.
No, you could just I don't think so. Not in chat, no. I don't think it'll be visible on YouTube.
Cool. I'll drop my phone number in there. Feel free to text me. But yeah, I think I just scratched the surface on this stuff, but happy to set up time and chat with it. I could talk about it all day. But yeah, so if anybody's interested, absolutely just hit me up and we'll set up some time.
Awesome. Well, thank you, Andrew. Looks like we're up to time. And Ben did have to say sorry because he got pulled into a meeting by his boss at the Houston Endowment. So that's why I've kind of taken over a little bit on the moderating duties. But this was awesome. This is really something new that I'm not exposed to with any regularity. So, Andrew, thank you so much for your time and presentation today.
Absolutely. Thanks, guys.
All right, y'all. Well, have a good day, and we'll see y'all at the next round of Pro Series. Y'all take care. Bye, everyone.